The Shanghai composite in China fell over 8% this morning after concerned investors dumped shares after a decrease in profits from Chinese industrial companies in June. Concerns about a fragile market in China have led to a sell-off in high-yielding assets globally as cash shifted to safe havens such as gold and the US dollar. Emerging markets have thus suffered, and the rand over the weekend was battered, hitting a new low against the dollar of 12.68 and 19.64 to the British pound. It has since made up a small amount of ground and is now trading at 12.61 to the dollar, 19.58 to the pound, and 13.98 to the euro. Gold is up over 1.25% for the day, and this has served ailing resource stocks, with the resource index up just over 2% and gold mining index up over 5.27% at the time of print. The JSE's biggest laggers are the industrials, which are currently down 0.2% in today's trade. The local all-share index is just under 0.05% lower in morning trade, and traders would have expected the rand to strengthen after last week's MPC meeting and subsequent raise in interest rates. But it was a non-event, and there has been little to no positive effect on the local currency. Global indices are off following the weakness in China, and volatility has entered back into the market in a week that has a fair amount of economic data. Core durable goods orders out of the USA today, UK preliminary GDP and US consumer confidence tomorrow, with the FOMC statement and federal funds rate from the US on Wednesday, and finally on Thursday, US advanced GDP and unemployment claims, followed by local month-on-month and year-on-year PPI numbers locally. In company data, Investec Limited goes ex-dividend today, and we are expecting interim results from AECI, Barclays and ArcelorMittal on Tuesday, Wednesday and Friday respectively. Our top moving shares on the top 40 this morning are Anglo Gold Ashanti, BHP Billiton, Kumba Iron Ore, Standard Bank and Netcare, with the day's biggest losers being Naspers, Investec PLC and Limited, FirstRand and RMI.